Welcome to StokTok's deep dive into Toyota Motor Corp. Toyota is the world's largest automaker by production volume, generating revenue across passenger vehicles, commercial trucks, and hybrid and electric platforms, with operations spanning North America, Europe, Asia, and emerging markets. The company's competitive position rests on manufacturing efficiency, brand equity, and deep vertical integration. As of May 8th, the stock is trading at $187.53. Over the past 52 weeks, the stock has ranged from $167 to $248, placing it well below its recent highs. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Toyota generates revenue through the design, manufacture, and sale of vehicles globally, from sedans and crossovers to trucks and hybrid powertrains. The company's moat is built on manufacturing scale and process excellence, lower per-unit cost than peers, combined with brand trust and a diversified product portfolio. Toyota also derives meaningful revenue from financial services and mobility solutions. The StokTok score on this name is 47 out of 100, a caution signal. Breaking that down, valuation scores very well at 20 out of 20, suggesting the stock is inexpensive. However, financial health, profitability, and smart money signals all rank in the single digits, pointing to real operational and capital structure headwinds. Growth does score a respectable 17 out of 20, which we'll explore in detail. Now, valuation. The question every investor has to answer: are you paying the right price? Toyota trades at a price-to-earnings ratio of 10.01 times based on trailing 12-month earnings, and a forward price-to-earnings ratio of 8.92 times. Both multiples are materially below the historical automotive sector average, signaling the market is pricing in either a structural earnings decline or significant execution risk. The PEG ratio, that is, price-to-earnings relative to growth rate, comes in at 0.54, which is extremely cheap. An EBITDA multiple of 7.92 times is also at the lower end of peer ranges. From a price-to-sales lens, the stock trades at 0.82 times sales, again below historical norms. Our DCF analysis, which models free cash flows and discounts them to present value, suggests the stock is trading at a 41.77% discount to intrinsic value. That's meaningful upside if the model proves correct. Wall Street analysts have a consensus mean price target of $256, drawn from 4 analysts covering the name. The high target sits at $290, the low at $221. That consensus implies approximately 36% upside from current levels. Taking both signals together, a reasonable fair value range in our view sits between $225 and $270. Now, to the latest earnings results. In the most recent quarter, Toyota reported earnings per share of $4.38 against an estimate of $5.48, a clear miss. Revenue came in at $13,456 billion, and year-over-year revenue growth was 8.7%. Operating income reached $1,191 billion, while net income came to $1,257 billion. These results, while showing absolute growth, landed below expectations and sparked some rotation out of the name. Market sentiment around Toyota leans bullish at this moment, with a sentiment score of positive 0.35 on a scale from -1 to +1. The bullish backdrop reflects expectations for sustained auto industry demand through 2026 and capacity expansions in key regions like India. However, geopolitical risks, including shipping disruptions, and the structural shift toward electric vehicles present real headwinds to that momentum. The valuation setup looks interesting to us, but the earnings miss demands respect. Moving to financial strength, how solid is the foundation? This is where the picture darkens meaningfully. Toyota's Piotroski F-score comes in at 4 out of 9. The Piotroski is a 9-point checklist that examines profitability, leverage, liquidity, and operational efficiency. Each criterion either passes or fails. A score of 4 means Toyota is failing more than half of those checks, suggesting deteriorating cash generation, rising debt, or margin compression. More critically, the Altman Z score, a bankruptcy risk model that weighs profitability, leverage, liquidity, and solvency, stands at 1.62. That places Toyota squarely in the distress zone. Scores below 1.81 imply elevated financial risk. The cash-to-debt ratio is 0.39, meaning Toyota holds only 39 cents in cash for every dollar of debt. That's a tightening liquidity position. The debt-to-equity ratio sits at 1.08, indicating that debt exceeds shareholder equity, a leverage level that constrains financial flexibility. Interest coverage is listed as not available in the data, but the current ratio, a simple measure of short-term assets divided by short-term liabilities, stands at 1.26. That's above the floor of 1.0, suggesting the company can meet near-term obligations. But it's not comfortable. The verdict: the balance sheet is under stress. Rising debt, compressed cash generation, and limited liquidity headroom are material constraints on dividends, share buybacks, or strategic capital deployment. Next up, profitability. Is this business actually making money efficiently? The most critical metric here is return on invested capital. Toyota's return on invested capital is 3.97%. That's below the cost of capital for most institutional investors, roughly 6 to 8% depending on leverage and duration assumptions. When return on invested capital falls below cost of capital, the company is not creating economic value on incremental investment, it's destroying it. That's a red flag. Gross margin, the percentage of revenue left after direct manufacturing costs, is 17.62%. In automotive, that's reasonable but not exceptional. Operating margin, which measures earnings after all operating expenses, comes in at 8.55%. That's the percentage of each sales dollar that flows through to operating profit before interest and taxes. Net margin, the bottom line, is 7.33%. So Toyota keeps roughly $7 in profit for every $100 of sales. That sounds okay until you consider the capital intensity of the business. Free cash flow margin, that is, cash available after capital expenditures necessary to maintain and grow the business, is essentially zero at 0.15%. That's a critical warning. The company is generating accounting profit but not converting it to cash. Given the latest quarterly results, both operating and net margins were under pressure, with the earnings mispointing to margin compression in a competitive environment. ROE, return on equity, stands at 10.02%, and ROA, return on assets, is 3.84%. Both are mediocre. The verdict on profitability is straightforward. Toyota is profitable on paper, but cash generation is anemic and returns on capital are inadequate for a mature industrial company facing capital intensity and secular pressure from electrification. Onto growth: is this business expanding, and at what rate? Over the trailing 3 years, Toyota has grown revenue at 15.3% annually. Over the past 5 years, the compound growth rate sits at 14%. Those are solid absolute growth numbers, reflecting rising vehicle demand globally and mix shift toward higher-margin vehicles. The most recent quarter showed revenue growth of 8.7% year-over-year, which is a deceleration from the 3- and 5-year average but still positive. Book value, the accounting value of shareholder equity per share, has grown at 13.1% over the past 3 years, which tracks the revenue growth, but suggests the company is deploying capital at a reasonable pace. The dividend yield is 3.34%, a meaningful income cushion for patient shareholders. The growth picture, in our view, is the least troubled dimension of Toyota's profile. The company is still expanding in unit volumes and in key emerging markets like India and electrification, while a structural headwind to profit pools over time is not an immediate threat to near-term revenue. However, growth without improvement in capital efficiency or cash conversion is not compelling. The market is pricing in this moderate growth trajectory, and any acceleration would surprise to the upside, while deceleration would test the valuation. Now let's talk smart money, What institutional capital is actually doing with this name? 5 top-tier investment gurus, as tracked by Dataroma, currently hold Toyota Motor Corp in their portfolios. That's a modest number, neither a strong conviction bet nor a consensus position among the most respected allocators. Turning to the broader 13F filing base, the quarterly snapshots of institutional portfolio activity filed with regulators. 4.3% of institutional filers are net buyers of the stock. That's well below the 50% threshold that would signal institutional bullishness. In fact, it suggests a wide majority of sophisticated money is either flat or reducing exposure. Insider ownership stands at 0.99%. Management owns virtually no skin in the game. Over the last 3 months, there have been 0 insider buys and 0 insider sells. That absence of insider activity, neither executive stepping up to buy at lower valuations nor cashing out at highs, suggests indifference or, more charitably, a view that the stock's valuation range does not present material asymmetry to management. The overall smart money signal is weak. The guru count is low, 13F flows are net negative, and insiders are silent. For a $75 billion market cap company, that's noteworthy. It suggests that the big capital allocators do not see a compelling risk-reward setup at current levels, and that's a warning flag we cannot dismiss. And finally, the verdict. Let's bring it all together. On valuation, the stock is cheap, trading at less than 1 times price to sales and a single-digit price-to-earnings multiple, with our DCF model suggesting a fair value range between $225 and $270, representing approximately 36% upside. On financial strength, the picture is concerning. A Piotroski score of 4 and an Altman Z score in the distress zone signal that leverage is high and liquidity is tightening. On profitability, Toyota is generating accounting earnings, but return on capital is sub-cost of capital and free cash flow margin is collapsing, meaning the business is not efficiently converting sales to cash. On growth, the company is expanding revenues at a mid-teen percentage rate, which is respectable, but growth without capital efficiency is not enough to justify premium valuations. On smart money, the signals are weak, few gurus hold the stock, institutional buying is minimal, and insiders are inactive. The recent earnings miss, landing earnings per share at $4.38 versus an estimate of $5.48, underscores that execution is deteriorating relative to consensus expectations. In our view, Toyota presents a classic value trap. The valuation screams cheap, but the deterioration in cash generation, the balance sheet stress, and the lack of smart money conviction suggest that the market has good reason to price the stock at a discount. The thesis here is not a slam-dunk buy. It's a name to monitor. If management can demonstrate a path to sustainable free cash flow, reduce leverage, and stabilize margins, the upside to $256 is real. But until the operational trajectory reverses, the valuation discount is warranted. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Toyota Motor Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.